All right, greetings class. This one is chapter 8 still. Current liabilities. We'll be looking at current portion of long-term debt, which has the acronym of CP, current portion long-term debt. So this is the actual part of the long-term debt that will become due over the next 12 months. So that's our definition of current portion long-term debt, amount of principal, because if we have long-term debt, that is a loan that we owe to another entity. So it's the amount of principal payable within the next year, the next 12 months. So this is the overall explanation. Hopefully it's easy enough to understand. So when an organization, if we have an organization, and we take out long-term debt, that means that the principal is due over a term longer than 12 months. So it could be 5 years, 10 years, 20 years, 30 years, long time. The debt is typically paid back over multiple years, hence the name long-term. But we also need to recognize the portion of the long-term debt that will be repaid over the next 12 months. So what we're specifically honing in on for this new account, because this current portion of long-term debt is a new account, current liability, normal balance of a credit. So we want to look at the long-term debt that will be repaid over the next 12 months and classify it or reclassify it as current portion long-term debt. This provides us with a better mechanism to show the decision makers what will have to be paid in the coming year. So if it's all still in long-term debt, in the long-term liabilities, management will not know what of that amount is coming due over the next 12 months, and they have to plan for as far as paying. At least on the financial statements, they'll be able to dig and get it, but it won't be there easily accessible. So we got a couple things that we're going to look at. So there's initial steps as far as the initial recording, and then on the next page we'll come back and look at what do we do if we have something that goes over longer than a 1 year period. So with the example that we have here, we have a $10,000 auto loan payable over 5 years, so that is the long-term debt, so that's long-term. But the principal is due in equal installments each year. So the loan is $10,000, 5 years, so that means that we would be paying $2,000 per year, which is $10,000 divided by 5. So if we think about the current portion, when we actually do the initial recording of this, the amount that's going to be due in the next 12 months, based on our definition, will be one installment of the 5 years, which would be $2,000. So let's look at it. So how we record it is we debit what is received in the based on the long-term loan. So either cash, equipment, auto. So for this one, it is auto. So we would debit our auto account for $10,000. Then we would figure out what amount of that principal is due in the next 12 months. And as we said before, it's $2,000. So we would record that in the new account, current portion long-term debt, and then the remainder of that, the $8,000, would go to long-term debt. So as far as a journal entry, this is what it would look like. And if we did this at the beginning of the year, so 1/1/2015, we create the auto account for the amount purchased, $10,000. That's our cost on the auto. We owe $10,000 in total, but the current portion due within the next 12 months is $2,000. The long-term portion is $8,000. So that's our recording. When we go to post this to our general ledger T accounts, this is what it would look like. So our debt is $10,000 in total, part of it current, part of it long-term, and we have $10,000 on the auto. So that's the first part of this, and that's the initial transaction. So let's look at the same example, same information, but what happens as this loan continues to progress. So we look at the second year and later. So when we actually come to pay the principal balance for the following year, we take it directly out of the current portion long-term debt account. So when that loan is paid, it comes directly out of the current portion that's due, because that is the one that's come due. So we credit cash, which will decrease our cash account, and we debit the current portion long-term debt, which will reduce the current portion long-term debt. So that means we don't have anything in the long-term debt account at this point. So what we need to do is we need to reset the balance in the current portion long-term debt account. So we look at the loan, how much of that is going to come due over the next year. And because it's equal installments, it's going to be the same $2,000 each year. And we just take that out of long-term debt. We'll debit that to decrease it, and we'll credit the current portion long-term debt. And this is what it looks like here to increase the current portion long-term debt. Then I'll show you what it looks like over here as far as how we actually post those to the T accounts. So Beginning of the year, we make the payment out of current portion long-term debt using cash. Then we've got to shift more money out of the long-term debt, which we decrease long-term debt with a debit, and put it back into the current portion long-term debt. So when we actually go to posting, these were our original transactions. We had the auto, so the A's are your originals. B's are when we actually make the payment, so cash comes out, and then we reduce the current portion long-term debt. So at this point, we would have a balance of 0 in the current portion long-term debt. So in order to replenish or reset the balance in the current portion account, we would actually do the last. We do the C. So we take the money out of long-term debt and we put it into current portion of long-term debt to refund that. So now we still have $2,000 that we're showing is coming due in the next 12 months, but the reduction of long-term debt is down to $6,000. So taken together, we've paid $2,000 on the loan, and the loan is currently showing at a balance of $8,000 in total, $2,000 current, $8,000 long-term debt. So that is current portion long-term debt.